Welcome to the 3 Edge Weekend Review for the week of May 13th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here today is Eric Biegeleisen, Director of Research and Deputy Chief Investment Officer here at 3 Edge Asset Management. Today, Eric and I will discuss what we're referring to as the everything rally. This past week, the S&P broke out to another all-time high. The Dow crossed over the 40,000 mark. But it isn't only the U.S. equities that have touched all-time highs. Many other asset classes and geographies have also reached new highs recently. European, Japanese equities, gold, commodities like copper. And of course, we would be remiss if we didn't discuss the recent return of roaring kitty and meme stocks. And then lastly, Eric will talk about how investors might think about their own investment portfolios in such an environment as we are experiencing here. So let's get started, bring Eric into the conversation. So Eric, the video's title is The Everything Rally. And before we get to the return of Roaring Kitty, why don't you just touch on precisely what we mean by an everything rally and what could be the potential significance of this phenomenon?
Yeah, thanks, Fritz. Thank you for having me here on the Weekend Update. The reason we refer to this environment as this everything rally is really, as you stated, it's a situation where you have many different asset classes and geographies all rallying to new all-time highs in certain cases, like you said, the U.S., Europe, Japan, gold, commodities. That's exciting. This is driven by price momentum. It's driven by, could be fear of missing out, just broadly these animal spirits of wanting to get in and participate. This is the type of behavior that is often associated with, that's late in a market cycle. It sometimes results in a market melt-up before a final peak in prices ultimately, before then perhaps coming back down in a significant way. And so this reminds us of the seasons of the market framework that we often show on these videos. That would suggest, if you were to look at the season, that we're somewhere in that late cycle, late summer, perhaps, where, equities and hard assets both can do well as they have so far. That said, as we know from studying past market cycles, market rallies, and stock market bubbles, they can last far longer than fundamentals or even logic might suggest. So, while things have done well to this point, how could this rally continue? How could it be extended? And so, the prospect of central bank easing sometime in the next few months, even just the anticipation of cuts rather than a continued pause or even like knocking out the prospect of a hike. All of that could help propel asset prices further. There's been no shortage of continued fiscal stimulus, and that's likely to continue at least until the election in November. And then finally, share buybacks. Which, just among the big tech stocks is massive alone, forgetting about the rest of the S&P 493. Was a bit slower, maybe, the buybacks in 2023, though still elevated. And Goldman Sachs recently estimated U.S. buybacks are going to top $1 trillion in 2025. So that, too, could be something that helps extend the rally across these different asset classes further.
Excellent. Very good description. Thank you. So now the fun part. Talk about the recent return of Roaring Kitty, a.k.a. Keith Gill, who I guess last Sunday he had gone silent for years, maybe, and then he posted, I guess. And one thing I do know is that within 24 hours of his post, I think there were 14 million views or something. So maybe you could, I know not everyone knows who the heck this Roaring Kitty is, so maybe you could just explain who Roaring Kitty is, where he first appeared, and more importantly, sort of like, what's the significance of this?
Yeah, Roaring Kitty is the online social media YouTube handle for Keith Gill, as you pointed out. He has a more colorful handle for his profile on Reddit, where he was a contributor on that Wall Street Bet subforum. He was at the epicenter of that meme stock craze, particularly in shares of GameStop, which went from roughly $1 per share to a peak of over $120 per share on January 28th of 2021. So here's a setup, right? GameStop was being heavily shorted by hedge funds. That is an investment in a stock where you bet you do well when the price declines and you lose money as the investment increases in price, and generally for good reason. declining sales and an outlook as a business as gamers are shifting their preferences right towards online downloads and away from physical media. So all of that kind of tracked. So Gill and others on these forums attempted a classic short squeeze, right? And that's where they buy up the shares en masse, as a big group collectively and artificially inflate the stock price up. Eventually the hedge funds, they can't stomach these losses from the increase in the price. So they throw in the towel on their short positions by buying back at that higher price, which in turn pushes the price even higher. So Melvin Capital was one of the high profile hedge funds that got caught in the crosshairs. So this all peaked in early 2021, eventually, lost that collective momentum. Gill and others eventually were brought in to testify before a House committee. Gill from that point on kind of went silent. Shares eventually drifted lower towards a more reasonable price that reflects the actual business. All that said, this week, Gill resurfaced in social media, as you pointed out, pushing the stock price on GameStop from that $10 range where it's been for quite some time, up to a peak of nearly $50 earlier this week, now trading down in that $30 range. And so to your broader point, this feels akin to the environment the last time this happened in 2021, where asset prices were generally all moving higher together like now and continued for some time following events like this before ultimately peaking with profit taking and some retracement. We saw some downward kind of sawtooth behavior with lower highs and lower lows, so perhaps the fact that this has happened isn't necessarily a tactical timing instrument, but it just gives you an idea of the type of investment environment that we might be finding ourselves in.
Excellent. Great. Appreciate that. And then, so as always, my final question speaks to how might investors think about positioning their portfolios in the midst of this everything rally? Do you participate? Do you not participate? If you do, how do you do that? Maybe you could just shed some light on that one.
Generally the response to this is always the same, I feel like, regardless of the season, which is broadly speaking for all climates, but that is to participate in a diversified manner, right? Both across geography as well as asset class, to the degree that you can lean in on those asset classes that are likely to outperform, like equities and hard assets near term, as we talked about being late summer in the cycle. But be very attentive for warning signs for the next correction, could be imminent. Examples of things to look out for, signs of a credit contraction or significant withdrawal of liquidity from the system, widening of credit spreads. And that can include, shorter term measures like looking at interbank spreads, investment grade, or even high yield. Signs of a renewed inflationary cycle. The market liked this last CPI print, we know, but we know service inflation is a bit stickier. So any signs of a reacceleration could indicate the increased likelihood of a more hawkish response from the Fed, which would likely be a negative for the markets. Stock general momentum and stock market price breakdown below previous peaks could be indicative of potential turnaround. And any escalation in any of the many geopolitical conflicts, that too could certainly indicate a turnaround, slowdown of fiscal stimulus. All of these are potential things that might take this everything rally down. Currently we favor high quality U.S. equities with solid interest coverage ratios, Japanese equities, Indian equities, and gold. So as we discussed, markets can remain irrational for extended periods of time. So while we do find ourselves late stage here, as long as the punch bowl is continuing to be spiked, the party is likely to continue.
Excellent. It's funny because I saw there was I picked up the FT late in the week, and the headline was that Starwood, the real estate firm, has now had to start to draw on their credit facilities because they're getting redemptions. And so that's sort of the type of credit scenario or negative credit scenario that can snowball and create problems. Because I know that you had brought that up. So thank you for that. And thank you for filling in. Thank you for your insight. It's a very interesting topic when trying to think about, well, how the heck do I invest in this current environment? And as you said, we believe that the best approach is, it's okay, participate, even at these levels, but do so in a risk-managed, diversified manner, and while being prepared to take defensive action with your portfolio when things should change. And then the discussion reminded me of a passage from Morgan Housel's most recent book, It's called Same as Ever, which is terrific. Highly recommend it. And he said the following. He said, growing belief that everything will continue to be okay, that markets will keep going higher, pushes the markets, like the law of physics, towards something not being okay. So, it's kind of a timely quote. There was a more reassuring quote that I also grabbed from it, though, and that is, history is filled with surprises that no one could have seen coming, but it is also filled with timeless wisdom. And that is what we seek to discover when studying market history here at 3 Ed. So, Eric, thanks again. Great to have you on the Weekend Review. And that will do it for Eric and me for this week. Steve Cucchiaro and I will be back next week for another edition of the 3 Edge Weekend Review. Now that Eric has set a very high bar for Steve, we'll look forward to that. As a reminder, our videos are always available on our 3 Edge YouTube channel. If you think you know someone who could benefit from the videos, please feel free to share them. So, until next time, on behalf of Eric, everyone here at 3 Edge, thanks for listening.